It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. Thanks for joining us, spending a little bit of time out of your weekend with us. We appreciate it. This is Jill on Money, live from the Capital One Bank studios. And we here, we meaning me, Jill, and Mark, the executive producer extraordinaire, are always very delighted that you care enough to turn on, listen, and send us your questions, comments, etc. If you have a financial question, this is the show for you. Here's why. Because we take the mystery out of your finances and we don't sell stuff. One dude just got in big trouble for selling some crap on his radio show. And just be careful. The only thing I'm going to sell you is that I'm going to sell you my book if you want it. But even that, don't go crazy. Although I really would like you to buy it. Let's be honest. The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. That is the title. But other than that, there's no product. There's nothing else. We do have sponsors. We tell you when we have sponsors. We tell you when we have something to disclose. We always do that. Like over the last couple of years, there was a sponsor of my podcast that was a name brand online advisor. And I would just mention that name and say, oh, by the way, they sponsor our podcast. Because that's what we do. We disclose when there's some sort of conflict. It's important to do that. So if you're listening to other financial shows and they're selling product, be very careful. Because we don't know exactly how the person hosting it is compensated necessarily. So just understand it. That's all. We like to begin our program with a caller, and today is no different. We are talking to DJ from Texas. Hello, DJ. Welcome to the show. What can I do for you?
Hi, how are you?
Fantastic.
I am struggling with what to do with my 401ks and a rollover IRA that we've accumulated over the years. I've just left it sort of on autopilot, contributing somewhere near the max, and combining the two, it's something in the neighborhood of $1.5 million. Mm-hmm. And it's all an index, very low load. And everything you read, says that since I'm 64, I probably should be thinking about putting some of this in bonds. But, everything I look at is just over a 10-year horizon. It's the earnings on a bond fund, on a bond index fund, are nothing compared to the earnings on the index funds.
Right.
So I'm scratching my head with, is it worth leaving some risk in place and continuing on, or should I be stuffing some of this into bond index funds?
That's a good question. Let's do a little math and see just how much money you need to pull from these funds. First of all, you're 64. When do you think you plan on hanging them up? Because you're still working, right?
I'm still working. My spouse is still working. It's one of those things where if everything stays the same, I'll probably work another 5 years, maybe more. There's a little bit of golden handcuff in there somewhere that may happen, but it might not too, and who knows? In our jobs these days, you get the boot, and that's the way it is.
Yeah, no kidding, right?
So it's 5 years, maybe 10 years, maybe it's 2 years.
Okay. So let's pretend it's 5 years. Let's take a stab at this. Yep. All right. In 5 years, let's presume you retire both at the exact same time in 5 years. Okay. At that time, at retirement, what kind of income would you be entitled to? First, let's do Social Security.
Both my spouse and I have maxed out Social Security, so whatever the max is at that time.
Okay. Pension?
It's about 3.
Okay.
My wife took early retirement, so she's got a believe it or not, a small pension from a prior company that will supply about $33K till either one of us are no longer here. So
okay,
it's guaranteed for either one of us for forever.
Great.
So.
I love forever. It's one of my favorite. That's my favorite payouts. Forever.
Forever until I'm forever. Yeah.
Exactly right. Any other money that's coming in? Because that's like $9,000 a month, basically.
Yeah, 10 grand a month, depending on where you pull the plug on Social Security.
Right.
And that's about it there. Of course, there's rainy day fund money, but that's just
What do you need to
sitting
live
around.
on? Would you guess?
Well, that's interesting. That's about half our income now.
Mm-hmm.
And of course, when you retire, you aren't stuffing more money back into 401ks and things. So I think that's fairly close to what we'd live on at some point. We've got to downsize our house. I don't need a great big house. And we'd probably move out of the Metroplex here.
I mean, you could and
free some cash from equity in a house.
Okay, even forgetting that. I mean, honestly, if I looked at your $1.5 million in 5 years, I mean, you could probably just pull $50,000 a year out snoozing, right? Like not even worrying about it. And you would obviously want to delay tapping that. I would imagine your required minimum distribution is going to be, tens of thousands of dollars, which will just you'll use it, right? You'll use it. You'll take some trips. You'll have some fun. So I guess the interesting part of this is you fundamentally get that over the long term, stocks have outperformed bonds. The question I would really be thinking about is, do I want to have as much volatility in my $1.5 million, maybe it'll be $2 million by the time you guys retire? Do I want to incur the ups and the downs in the same way? So what I would suggest to you is this. Yes, of course, if you have the intestinal fortitude to withstand the ups and downs, yes, index funds that are invested in stocks are probably going to perform over the course of your whole retirement. But, you don't give up that much by having some of those lower income producing products that are basically less volatile. And so I would actually be very interested in peeling off some of those index funds and trying to replace the stock index with some of the bond index, maybe not all at once, but presumably I would like to kind of get you at least to more of a, 60-40-ish kind of place, maybe 65-35. You'll still make a ton of money on the upside, but with less volatility. So, DJ, hang on. We're going to go pay some bills. I'm going to come back to you and let you sit through the break and chew on that a little bit and see if you could live with having a little bit of autopilot with maybe not as much upside, but also maybe not as much downside. So stay tuned. We'll get back to DJ and his $1.5 million in a couple of moments. You are listening to Jill on Money. During the break, hop onto the website, jillonmoney.com, and you can sign up for our free weekly newsletter there. So cool. All right, we'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You are back. It's Jill on Money. And before we went to the break, we were talking to DJ from Texas, he and his wife are in their early 60s, going to work for at least 5 more years, have saved a pile of money in retirement accounts, about $1.5 million. And, the essential question is, what should DJ do about the allocation in these funds? Because right now it's stock index funds. And when he looks at bonds, he kind of like says, that looks pretty rotten compared to the stocks in terms of performance. But what I'm suggesting, DJ, is that You look at it slightly differently as you come into retirement, which is, hey, you know what? I got to preserve a portion of this. You don't need all of this money at once. So I get it. You can have risk. Essentially, you could be investing honestly for 30 years. So I don't have a problem with risk, but I do think that there is this nagging sense that it's no big deal to go through a bear market or even a once-in-a-generation financial crisis while you're still working. But when you retire, it does start to hit you a little bit differently. And so I would think about adding some bond index funds just to kind of pull the risk back a tiny bit. Again, you don't need all the money. The only time you're going to need this money is when you're probably forced to take the money when you're 70 and a half for your required minimum distributions. And then you do need to have some cash accumulating. But would you feel comfortable just kind of slowly rotating into a little bit of like if you had $1.5 million, how would you feel if $500,000 were bond index funds?
That would work. The other way I look at it is between Social Security and a pension, there's no risk in that. That's absolutely going to be there.
True.
Every month.
Yeah.
And my only risk exposure are these two, the one 401k and the one IRA account that are heavily indexed. But I can certainly move one of them into something like an intermediate sort of bond fund.
Yeah, and just like
be happy with 2 or 3%. I suppose.
Yeah, and I think that it's really a question of what is the appropriate amount of risk for someone in your situation. Look, you've lived through a lot of bad times, so you know what it feels like to see that account go down. But as I said,
just close my eyes.
Yeah, close my eyes, grip the rail very tightly, and enjoy that first plunge. What I didn't ask you about, and I should ask you about, is you got some kids that are grown up, or where are you in that?
Well, I've got 2 semi-adult kids, a 28-year-old going on 18. Good kids, but they aren't completely launched. And I've got to get them out of the National Bank of Dad at some point here.
I love that. NBOD. You know what? Everyone has like a little bit of that in them. There was recently a New York Times article about these adult kids who still get help from their parents. So you said you have a 28-year-old and there's another one also. How old is the other one?
A 23-year-old.
Now, if the 28-year-old is going on
living at home.
Oh, wait a minute. So I was going to say, if the 28-year-old is going on 18, what's the 23-year-old going on?
16.
Okay, great. So you still got to think about that in terms of...
Think about it every day, Jill.
Yeah. We're going to have to... We should hook him up with Dr. Jim Grubman, the wealth psychologist. Okay. That's a totally separate issue. I get it.
Absolutely.
All right. But you are part of that $9,000 to $10,000 a month that will be coming in your retirement. You start, or maybe in the back of your head, you think there will have to be also some money that could potentially be put, around for the kids too. So again, you have plenty of money to do that. I get that. What about, do you have any long-term care insurance?
No.
Okay. And do you have wills, trusts, all that nonsense, estate plan stuff?
That is on my radar. That's on my list this month.
Very good.
I haven't have it yet.
All right. That would be, I tell you what's interesting about the estate plan and what it might prompt in you is really thinking much more thoughtfully about how you want to handle the money and what you want to happen with your kids. Because if you've got, teenagers in emotions, but, almost 30-somethings in age, you want to plan this estate accordingly. Because right now, God forbid, if you and your wife were in a car accident and dropped dead together and these kids got $1.5 million, probably you wouldn't feel like that would be the best outcome right now, right?
Probably not.
I mean, there would be a great party in your house,
kids,
I think.
Good kids, but, they didn't inherit much DNA, it doesn't seem, from the intellectual side of me and my wife.
I like a man or a woman who is very honest in appraisal of their kids. So I think that estate plan actually comes up to be a big issue for you guys. I really do. And I think that will prompt you to maybe even think about these retirement accounts in a slightly different way. For example, if something were to happen to both of you and you have one account that could basically be invested very gently in the bond market, and maybe that would be money that the kids could use. They could tap that in a different way, and maybe you would make some wishes known about how much money they could inherit at what point, and maybe because neither of them is particularly financially savvy, you've got to really think as to whether you want to have somebody close to you act as the financial guardian of these kids or a trustee of a trust. These are the kinds of questions that a competent estate attorney is going to ask you. It's weird, right? Because you don't have an estate tax problem. You don't have a tax problem. You have an estate problem, though. And that should be worked out. So I think that's actually, I'm glad that's on your radar. I think that, if you could get that done, if that goal for you would be, by the end, before 4th of July, I want to have a draft of some estate documents created. That would be a good goal for you because it's going to take you a while. And you and your wife are going to have some tough heart-to-heart conversations. It's very emotional, and I totally understand it. I think you do that estate plan. And then I think it's really about getting some of the money. Maybe this year you say, I'd like to have like a third of my money into bond funds. It doesn't have to happen all at once. You can do it a little bit at a time if you want to. There's no tax issue because these allocation decisions are being made within a tax preferenced account, an IRA or a 401k. So you can do it as quickly or slowly as you want. But I do think that your goal should be maybe by the end of the year to at least have a third of the money in bond index and then see where you stand at the beginning of next year. See where it is and see if you've if that's good enough and you've gone through one rotten period of time and it feels kind of like, oh, I'm glad I had those bonds. Maybe you'd put a little bit more in. But I mean, for now, I think that's a good goal for you. And it's not too sudden a shift in the allocation. And that I think would be very helpful for you.
I like that plan.
Yeah, me too. I think it's one of those things where you know what you have to do or you feel like you know what you should do. And it's just, we want to make sure you get there. And if I say you have to do this all in the next 2 weeks, it ain't happening. So it sounds like you've done an amazing job, really. And so I should have just led with that. I buried the lead, which is you and your wife have done a fantastic job of saving. And so I absolutely congratulate you on that. Let's get this stuff buttoned up a little bit. And let me know how it goes. And if you need help and you want us to hold your hand, I'm here for you. So just keep us in mind and keep us updated if you run into any stumbling blocks, okay?
Thanks, Jill. I appreciate it.
All right. Good luck, DJ. Thanks for calling.
Thank you. Bye-bye.
Bye. That's a good one. Mark, I love these parents that are just out there about their kids. So anyway, you guys, Mark, maybe we could put a link to that New York Times article, which is... It was back in, when was it? February? March, beginning of March. It was called The New 30-Something. And it was funny. It was written and directed about, I think it was probably directed at millennials. And the new 30-something, have you or haven't you cut the financial cord with your family? And the premise is this. And I'll just read you from the headline. How does anyone, even those with a stable, upwardly mobile job, let alone a family, afford to live in places like New York, Los Angeles, Boston, Chicago, San Francisco, or Washington, D.C.? The answer? Many are bankrolled to varying degrees by their parents. Hold your nose and read this one, baby. It is interesting. All right, you're listening to Jill on Money. If you've got a question, we'd love to hear from you. Ask Jill at jillonmoney.com is our email address. Hop onto the website. Go read, listen, watch, and buy the book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back with Jill on Money. If you've got a financial question, I want to hear from you. I'm pounding the desk. Can you hear it, Mark, if I do this? I want to hear from you. Mark, does it amuse you that I amuse myself? I know. You should see me do these radio hits when I'm sitting in my apartment. Because we do this from a studio and the sound is so great. But when I'm doing hits with your local stations and you hear me on the radio, I'm usually in my apartment doing those with the beautiful, exciting technology that is featured. Anyway, I put that out there because I do amuse myself quite often. Susan writes, I'm 80 years old. This could be my mother. My mother's writing me right now. Just kidding. Different email address. I haven't heard a word about an increase in Medicare to pay for. I haven't heard a word about the increase in Medicare, which I think went to pay for tax cuts to the rich. Not exactly. Social Security benefits. Her Social Security went up, but her Medicare also went up, leaving her with $103 less per month in 2019. It's because my income was higher than usual, and it was a one-time event. I live in Florida. I was managing 2 rental condos, which became difficult. I did 2 1031 exchanges. I ended up with a taxable overage of a big chunk of money. I sent a big check to the IRS. I made some upgrades to my new rentals. I replaced an old car. When I file, will I be able to return to my old status, or am I stuck with this situation forever? You know what I would do? I think this is one of those cases where you absolutely positively should be using a tax preparer, because I think that this is one of those weird 1 years where you should be very careful. So that's what I would do. I don't really think that I don't think that's a financial planning question. It's a tax question. And when you have these unique situations, even if you file yourself, it might be worth it for you to go see a CPA or a tax preparer so that you can get some advice about going forward. That's my advice to you. Okay. This is from Jennifer. I listened to your interview with David McKnight on taking advantage of the current low-tax environment. He mentioned maxing out Roth IRAs, but didn't mention anything about Roth 401ks. Oh, I love the Roth 401k. I'm sorry if we didn't do that. Anyway, she is a federal employee with 14 years or so to go before retirement. She maxes out a Roth IRA at Vanguard. She's got $200,000 in her traditional thrift savings plan account. And I don't see any drawback if I stop contributing to the traditional TSP and start contributing to the Roth TSP. Absolutely, I agree. Her income is $76,000, and she's going to claim the standard deduction. Her taxable income is pretty low, $64,000, well below the limit of the 22% bracket ceiling. I don't foresee earning over the 22% ceiling at any time. Am I missing something? No, you are not. This just absolutely makes sense. So, good idea. Go do it. I love the Roth. This is a perfect situation for that, and I would encourage you to do just that. Use the Roth option. These Roth options in the retirement accounts in the employer-based plans are really helpful. Okay, here is a note from John, who's turning 62 or just has turned 62. So he has a history of kidney cancer. Oy. I've always been a saver. I'm reluctant to start taking payments from my IRA account. 5% a year is 20 years. I'll be 82. My mindset doesn't seem to want to, but these are my golden years. Retired 3 years ago from UPS. John, spend some money for God's sakes. Don't deplete it. But if you're living okay, you don't have to take a ton of money, but you could take some money. I'm not saying you're going to die tomorrow. You don't sound like you are, but I do think it's worth it for you to live a little. And you don't want to spend more than you don't want to run out of money, because maybe you will live a long life. But please, come on. You can do this. You can spend a little bit of money. All right, Timothy. College loan. I want to borrow money for my daughter's college tuition. What's the best place to borrow money? How do I go about borrowing the money? Parent Plus, Fannie Mae, another place? Have you decided actually that you can afford to pay for college? This is an entire chapter of my book, The Dumb Things Smart People Do with Their Money. I am worried that parents are borrowing more money than they should be for their kids' college education. So, Timothy, how about this? How about Mark's going to send this to you, and I would love to have a conversation with you. We can just do it right on the air. It'll be very easy. And I want to know whether this is actually something that you should be doing, because I am not sure that you should be. But yes, of course, you can get parent loans. You can do that anywhere that you get college loans. I would also encourage you to check out Beth Kobliner's website, Beth Kobliner with a K, Kobliner, BethKobliner.com. We Need to Talk College. That's an awfully good place to start. And you can also have your daughter, go check out Next Gen Vest. NextGenVest.com. She'll be paired with a money mentor. That could be a really good thing to do, because if you do that, then you're getting her involved in the process, and I think that's incredibly important. But let us know. Here's a question from Bonnie, who listens to me all the time. When the government releases jobs reports, where does it get the information from? Oh, very interesting. So, two pieces. There is something called the payroll survey, which is like, hey, this many jobs are added or removed from the economy. They go directly to companies. And then the unemployment rate is actually calculated based on what's called the household survey. They don't use information from job boards. Does it have any impact on the raising or lowering of interest rates? Yeah, it's another piece of information. It's a piece of information that the Fed uses in trying to understand what is the state of the economy. Is job creation really increasing? Are wages up? Sometimes wages can be, if wages start to go up, the Fed might say, we think that there's going to be inflation bubbling up. So all of this is useful information for the Fed. It's not a direct link, but it's part of what the Fed considers when they look at interest rates. That was that slug of emails, my friend Mark. He says he's got about 10 more, and I'm going to do them, darn it. If you've got a financial question, you can contact us two ways. Go to the website, JillOnMoney.com. No worries. Just do that. Contact us. Boop. Easy peasy. Okay. If you have a financial question and you just want to email us, ask Jill at JillOnMoney.com. We will be right back.
If you've missed any part of the show or want to check out a past show, go to JillOnMoney.com for more great personal finance content.
You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. Our email address is askjill at JillOnMoney.com. Our website is JillOnMoney.com. While you're there, you can sign up for our free weekly newsletter. And because that's such a bargain, you should also buy my book. See, one thing is free and one thing I charge you for. Get it? A little bit like a balance in life. Asset and liability, if you will. The dumb things smart people do with their money. 13 ways to right your financial wrongs. You can get it on the website, JillOnMoney.com. Just click on the book. Denise writes that her husband passed away last August. They have 401ks with the company they worked for. They are both retired. They also have IRAs with a financial advisor who uses Fidelity to manage our funds. The company 401k investments are okay. The fees are much lower than what my advisor is charging me. My husband used this guy for years. There have been thousands of dollar investments that were not good advice, in my opinion. How can I find someone in my area I can talk to and roll my money to another firm? I'm going to be 61 and I just turned 61. I need my funds to be stable since my income has decreased due to the loss of his pension. Denise, two choices for you. You can check out NAPFA, the National Association of Personal Financial Advisors. And you can also go, so that's napfa.org. And you can also go to letsmakeaplan.org. That's the CFP website. And if you want to follow up, just tell us where you live. Maybe we know someone around your area. So do that. Okay? Tom writes about an inheritance that is coming his way. I have a notarized deed in which my father is giving me and my two siblings each 1/3 of the value of his fully paid house. I'm in Pennsylvania. The house is in Maryland. My expectations are that my father will live another 5 years or more, and he lives in the house currently. Upon his death, the house will likely be put up for sale. Each of the 3 siblings will divide the proceeds equally. Is there a best way to receive those proceeds from the sale? I expect there will be taxes to pay. Not sure if I should accept a check directly as myself or set up some legal entity. Okay. Why is your father giving you a third of the value of his fully paid house? Here's the problem. I don't know if he's done it already, but if he does it, when he gives you the house, he gives you his cost basis. And I don't think it's a great idea for you to get his cost basis in the house. That said, if he's already done it and he's given you the cost basis, you'll receive the proceeds as an individual. That's the only way you need to think about it. And the difference between the sale price of the house and the cost basis, what he and maybe your mom paid for the house and whatever else they put into that house would raise the cost basis, you'll pay tax on it. That's it. There's no way around it. And it doesn't really matter whether you don't have to, there's no shenanigan, basically. It's just what you have to do. He also notes his wife and he earn about $125,000 a year. That means you're going to pay a 15% long-term capital gain. So, not terrible. But that's what you're looking at. Everyone needs to stop their parents from just giving them their houses. There's no reason to do this. This is like some weird shenanigans that people are doing. Oh, I want to try to qualify for Medicaid. I think this is overdone. Rick writes, my wife and I bought two $300,000 term life insurance policies when we were in our 40s. We're nearing retirement. We've accumulated just shy of $2 million in assets. The term life policies are valued at Okay, hold on a second. These are not term life insurance policies. These are whole life insurance policies because they have cash value. So the policies have $50,000 in value, and they could pay off the house with that, save monthly premiums. Should we take a cash out, pay off the home, and use the extra $1,000 to build retirement cash? Yeah. Be sure to check with your insurance company as to whether or not you have any tax liability associated with that policy. That would be the main issue. If you do, it doesn't mean you shouldn't cash it out, but you don't need insurance anymore. So grab that moolah and move on. Okay? How much time do I got? 2 minutes. Let's see. Randy writes, to supplement, my wife and I are looking to supplement our income, and we withdrew money from my traditional IRA account. After taxes, it netted us $2,500 a month. In 2019, we will gross about just nearly $40,000 from Social Security and my part-time work. As a result of the sale of some property, we'll be getting a payment of $130,000. If we continue to need additional money to meet our expenses, would it be best to take from the $130,000 or from the traditional IRA? From the $130,000. It's already been taxed. So the current IRA is valued at about $980,000. So absolutely use the money that has already been taxed. Do not take it out of the IRA if you can avoid doing so. In fact, you might want to leave, once you pay your taxes on that money from the cash, maybe you just keep that as your little floating fund to pay you. It's better to use that than to use your IRA funds. Much better. All right. You are listening to Jill on Money. We're plowing through these. When we come back, let's finish up the hour. We'll do another question or two. And if you need to contact us while we're during the break, we're off, you're poking around, just send an email. Ask Jill at jillonmoney.com. We'll be right back. You're back with Jill on Money. We are broadcasting live from the Capital One Bank studios. Jeffrey writes that he had a 401k investment actually from 1989 through 1991. And he had money in there. He then moved to Texas. He forgot about it till recently. The bank is gone. I need your guidance. I tried locating it. I gave up. So how can I find this? Well, do you have any? Here's a question. Is there any statement? You really just need any statement that you can put your hands on. If you can do that, then we can start someplace. If you have no statement and no recollection, it's going to be a lot harder to find this. See if you can scrounge up some statement somewhere. Okay? And I don't know. This is a tough one. See if you can find something. Maybe even an old tax return might have it, but I don't know. You probably don't have that. Someone wrote in about some strategy about whole life insurance called RAFT. I have no idea what that is, so I'm just going to say avoid it. Since I don't know what it is, I would try to avoid those kinds of things because it's whole life. So just stop. Everyone stop. Stop. I'm having a hard time. This one's long. Property for sale. This is so funny. I had property for sale for $210,000. The first offer was $190,000, and I felt like it was an insult. Why do people get insulted by this? Just a bid. Relax. Owes $172,000. Blah blah blah. So now the most uncomfortable option is three choices. Why don't you just hit the bid? What's so bad about this? And I wouldn't. He said take out a home equity and update the kitchen. I would not do that. Second option, settle for $200,000 to get it off my hands and pay $2,000 in closing. Boom! That's it. There's your option. Sell it, man. Sell it. All right, when we return, more of your questions. Stop being pigs, everyone. Don't be insulted by anything. It's just a house. Don't be insulted. You're listening to Jill on Money. During the break, hop onto the website and be sure to sign up for our free weekly newsletter. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. So delighted you are joining us today. This is the Jill on Money program. We are broadcasting live from the Policy Genius studios. Policy Genius is the easy way to compare and buy insurance. A lot going on right now. Tax season. Mark, did you see that article that talked about 10.9 million people who weren't going to get their SALT, their state and local tax deductions? They were going to cap, and it blaring headlines, horrible thing. Everyone calm down. We do not have final statistics about who wins and who loses with this tax bill. There will be some losers, no doubt. But I don't want to overstate it either. There's probably many more winners than losers, or at least neutrals. So if you live in a high tax state, you're getting ready to do your taxes, you're right in the heart of it, I get it. We have an awesome guest. His name is Ed Slott. He is the king of IRAs, Roth IRAs, and all things taxes. Here's our interview with Ed Slott.
People thought they were getting all this money back because that's what they were promised, and they don't understand the difference between a refund and paying and their actual tax liability.
So what happened was we get this big tax cut at the end of 2017. And in the beginning of 2018, the IRS changed the tax withholding tables, which is how most people pay their taxes, right? Through my income. And it goes right out of your paycheck.
Right.
No problem.
And you live on a net paycheck.
And for many people, they may not have noticed it, but their net paycheck could have been higher throughout 2018 by a little bit.
Right. But it's a little bit each paycheck. And that adds up. Even if you're paid monthly, that's 12 paychecks. A lot of people are paid weekly. It's a little bit times 52.
Could this be a bit of an issue in that with most people now getting paid with direct deposit, that you're not looking at your pay stub necessarily? Kind of all goes in, right? You know, remember when we used to get paid and we'd look at the stub and you'd say, The first paycheck you ever got, you said,
Yeah. Who
"What's
is this guy FICA?
Hate
Where's
him.
my
Hate him. Hate that FICA guy." And we don't do
Right.
that anymore. You just
Right.
some
Yeah, you're
money,
right. It's
And-
just a net amount. That's my net.
Okay.
And I'll get this big refund. Matter of fact, this is where the expectations come in. They say it'll probably be even a bigger refund because look what he said, a big tax cut.
70% of Americans are going to get money back, was what they
Right.
said. And so what has happened is we now have a great teaching moment with Ed Slott,
Yeah.
where we found out that the amount that was withheld changed. Your net, many of you, not every one of you, okay, I get it. Many of you got a net amount that was a little bit higher, and that little bit was partially your tax cut.
Yeah. Or your refund
Or
in
your
advance.
refund in advance. Now you go to file, and instead of getting $2,900 refund, you got a $2,700 or a $2,400.
Or you might owe.
Or you might owe.
And this is a shock to the system, and it does reverberate through the economy, all the spending that was projected.
let's start with like a few different cases. So you don't owe, but your refund is smaller. Should you adjust your withholding?
Well, if your refund is smaller, maybe not. The theory is you've been giving the government less of a loan all of that time. But there are some people that count on a big refund because they have it earmarked to pay down last year's credit card bills, or it's never to save. I never heard anybody, I've been doing taxes for 40 years, and I never heard anybody, "Ooh, that's a big refund, I'm going to save it." I usually have the people sitting in front of me and say, "Oh, let's go here, let's go there, let's do this." They have it spent. So if those are your expectations and you have it spent and it's not there, that's going to be a problem.
And if you are a saver, then just take that fatter paycheck and do something with it. I mean, it is easier to kind of direct money than it ever was. So you can have more money go into a retirement account or set up an automatic draft to an IRA account or a Roth IRA account. All those things can happen. You got to do something, of course.
Yeah, that's a good point. And it ties in with your earlier point where you don't see the money. It's direct deposit. If you could set up, say, an average worker can do a Roth IRA and set up a little bit of each paycheck, you wouldn't even feel it. In the end of the year, you'll have the $5,500 or $6,000 in a Roth IRA without even feeling it because it's just in that net check.
And for those of you who are listening, getting that money to work for yourself, it's so much easier because there are very low cost options. There are no longer these big fat minimums. There's a zillion different places you can do this. Okay. So what happens if you owe a lot of money? And give us a scenario where someone may have gotten a refund in the past, but now is owing thousands of dollars. I'm not talking about someone who sold a big piece of real estate or
Right.
something, but who is the person who that usually would be in this scenario?
Do you mean somebody whose income is relatively the same,
Yes.
but because of the withholding, they didn't do anything different? There were no aberrations.
Or that they didn't realize that whatever their withholding was not going to be withheld to account for the fact that they could have a limit on their state and local tax deduction, or
Right,
that's something.
right.
So who are those people, do you think?
Well, who are they or what are they supposed to do?
Let's say, who are they and what should they do?
All right, those are people in high tax states like New York, Connecticut, New Jersey, or California, all over the country, and they're realizing they're not getting the tax deductions that they thought they would have, and it's people with children. Remember, all the exemptions are gone. If you've seen the new form, people say, where do I take off my kids? No, that's part of the new bigger standard deduction. That was taken away. So there's been a lot that's been taken away that you probably don't notice, but it's now all in the standard deduction. So you may have to adjust your withholding going forward, and if you owe money, you probably won't get a penalty if you withheld at least what you withheld in the prior year. And IRS has already come out and said, we're going to forgive some of these penalties. I guess they have to because of the backlash. But as long as you pay what you owe by April 15th, you should be okay.
What do you think is a reasonable range for a refund where you should just say, like $1,000 or something? You don't have to
Maybe
change.
that's good. Look, in the perfect ideal world, you want it to be zero.
Right.
because then you didn't give the government a loan for the year you paid your exact tax. But that almost never happens. So, yeah, probably 0 to 1,000 refund, just so nobody wants to owe money. That's the worst thing as an accountant. You tell people you owe money. Then they think, well, can't you do better? Sharpen your pencil.
I know. It's not good. And so there's a couple of big changes. I guess the question would be is what people will have to do to really judge their own situation is to say, look at your 2017 return, look at your 2018 return. Because I think that there are people who are saying, well, I've lost my exemptions, but maybe they're doing better anyway.
There are some people that are doing better with the higher standard deduction. See, this is a new tax system. You can't even do what you just said, compare 17 to 18. It's not apples to apples. They're two different tax systems. So this will be the first year you can look at 18, and with all the projections, nobody really knew how it would come out because everybody's situation is different. As you just said, some people will benefit from the higher standard deductions because maybe they didn't own a home and they didn't have big mortgage interest and taxes and things like that, so they did better. Right now, this year, when you do your 18 return, will be the first time you'll see how this new tax system affects you, and then you can plan ahead. That is the baseline.
We'll get back to our interview with Ed Slott in just a minute. If you've got a financial question, we'd love to hear from you. Maybe it's a tax question. Just send us an email. Ask Jill at JillOnMoney.com. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back with Jill on Money. Hey, big news over here at Jill on Money Land. I don't know if we can call it that, Mark, but I liked saying it. Book is cranking. We're doing great. And I want to thank everybody who's written us and told us that they've read the book or purchased the book. For everyone else, if you want to get in on this action, go to the website, JillOnMoney.com. Click on the link that says The Book, The Dumb Things Smart People Do With Their Money. 13 ways to right your financial wrongs. And you can join the conversation, too. Hey, if you bought the book and you like the book, go to Amazon. Throw up a review. I don't know why, but evidently the publisher says they like that. Let us get back to our interview with Ed Slott because it is a different tax season. I think that a lot of people are freaked out by it because of the new tax law, but you shouldn't be necessarily freaked out. You might actually have an easier time filing this year, maybe. But you don't know until you get going, so get going. And to help you out, here's Ed Slott. So will it be easier with a higher standard deduction?
Yeah, well, most people will file a standard deduction. Many more people.
Like up to 90% of taxpayers, I thought?
It could be. Yeah, it could be. Unless you had high medical or charity, but most of that's figured into the standard deduction. So from that perspective, it will be easier for most people. So it's just getting used to the new forms, but nobody uses forms. Everything's online. So this whole business that it would be a postcard, there is no
so
such
stupid,
thing.
I know. So, okay, with a higher standard deduction, we also had a big change in rates. Right? So the one that I always am really kind of like key in on is this rate of 24% because it's a huge rate and a lot of people are in that.
Right.
So
the rates have come down low. There will be people paying less tax that are using the standard deduction. But again, as you said, if you're a wage earner, you may not have seen it because you got it back all through the year.
What about the rich people, all of your friends and your clients?
Yeah.
So these people, the highest marginal tax rate is 37% plus that 3.8% Medicare surtax.
Income,
okay.
Right.
If you're married filing jointly, that kicks in at $600,000.
Right.
So does that mean if you're like making, let's just do like some of your friends there in Long Island, the couple that makes $800,000, lives in a big house, still itemizes, but caps their SALT deductions, their state and local tax deductions, but their tax rates are lower. Do you think those people are going to pay more or less in
They'll
taxes?
probably pay a little less in tax. Actually, the more you make, the bigger benefit you have out of this tax law.
Good thing I sold my book last year, huh?
Yeah, but when you say 37%, that's only the top dollars. That's the marginal rate. Your effective rate can be in the 20% area.
What do you
The
think?
effective rate, the rate you actually pay on each dollar earned.
Right, meaning that you
Net
take
of deductions.
So what you do is you take your total tax bill, which
Right.
you'll find from your returns, and you take that amount and you say, "Oh, what did I earn? Here's what I paid." That's really your effective tax rate.
Right.
Okay. So now let's talk a little bit about when we look at going forward. Are you still thinking, because tax rates are going to stay this way till when? 2025? Okay. You still say to me, the Ed Slott mantra, I always quote you, this is probably the lowest tax rates you will ever see in your life.
Yeah, this is the lowest. This is the time to act. For example, to put money in a Roth IRA, do a Roth conversion. It's kind of counterintuitive, but the best way to pay less tax later, when you need the money most in retirement, is pay a lower tax now. The way to pay less tax when it counts is to pay some tax now at lower rates. In other words, you're buying the taxes on sale, especially on an IRA or a 401k. That's money you're counting on for retirement. And in retirement, the last thing you want to worry about is tax rates going back up to 30, 40%.
Okay, let me give you a hypothetical, because this person is a friend of mine and asked me.
You're
So-
asking for a friend.
No, you'll know it's not me when I tell you that partner at a law firm
Yeah.
makes $4 million a year
Right.
in New York. They introduced a Roth 401k.
Great.
So I said, that sounds like a do to me. That
Yeah.
sounds like a good
Yeah.
thing. Like $4
Now,
million.
some people will say, but don't you want to get the big tax break with a regular 401k, a benefit, while you're in a high bracket? That could be right, but you don't know what your future bracket is. Look at the deficits we're piling up. The math is on the wall. At some point, any politician that says, I can cut your taxes, at this point is just saying, I'm bad at math.
Right.
Right.
Or lying. Either one.
Well,
one
I
or
don't
the
know.
other.
Maybe they just, want to believe that rates can stay low forever. Mark Twain had a saying years ago, history doesn't repeat itself, but it rhymes. And we can easily go back to the days of the 70s, 80s, where rates were 70, 80%. People think that's a horror, but that's what it was for many, many years. I'm not saying we'll go up to that, but who knows? You could go up to 50%. The last thing you want is a 50% tax rate in retirement. That means you only have half your money to spend. I'd rather pay the tax now on a Roth conversion and move your money, what I call from forever taxed to never taxed.
You know, it's funny. So I had that exact reaction, and then partner comes back and says, I spoke to my financial guy, and my financial guy says that's crazy because I'm going to be there's no way I'm going to be in the highest tax bracket when I retire.
Yeah, here's the argument on that. I'll be in a lower tax bracket when I retire. But what they don't realize is if you leave the money, say, in an IRA for retirement, that money is forced out at 70 and a half. We see clients already that have more income from required minimum distributions than they did their best day on the job. So it's not if, but when. This tax will be paid. It's not if, but when will it be paid? And the lowest rate when it's being paid could be higher than today's rate.
So I think that's interesting, because I have been feeling very much in line with you, which is I know what the number is today, and it's not. And
Right.
if it were to be lower, or if it were a push, a break even, I'm still happy knowing what I have paid. Right? I know what the amount is, because the future one. I mean, look.
It's an unknown, yeah.
It's an unknown. We have, as you said, there are a lot of things that we want to pay for. We also have a bit of a populist backlash where people
Right.
are talking about higher rates. So it's not as if people seem to think that, like, well, I look at 37%, I won't be making 500 grand. You may not be, but the tax rate still may be 37%.
That's exactly my point.
Right?
Right. And the Roth IRA, or any time you can move money now, even at a smaller tax cost, to a tax-free account, you're removing the uncertainty of what future higher rates can do to your standard of living in retirement when the paychecks stop and you're the most vulnerable and you need every cent.
And then it is nice to know that money has already been taxed, and
Yeah, it's
I
bought
don't have
and paid for. It's like a free and clear house. That's what I always compare it to. Do you want to pay off your mortgage so you don't have the problem later? What if you had a mortgage in retirement? That could be a problem.
So I love that. What about, so you think tax rates are going to go up? What do you think?
At some point
And what
in the
what about
future.
capital gains going into the same as your marginal? Do you think that's a possibility?
Well, we had that for a short time in the 80s.
Mm-hmm.
I really don't see why. I mean, I'll probably get a big backlash. Why your labor is taxed higher than your investment income.
And you're not some bleeding heart person. You are not.
I believe in a fair system. You shouldn't pick winners and losers. Why is somebody's labor taxed more than somebody who, makes money on investments? That's why Warren Buffett always says he's in a lower bracket than his secretary, because she has labor and he has capital gains. At some point, it could be likely that those rates will merge. They'll be the same. That's really what it should be, I think. No matter how you earn your income shouldn't determine what your taxes are.
Let's talk a little bit about also some of the, like we saw in this tax change, that we had a limit on state and local tax deduction. But before they did that, they did float the idea of throwing out mortgage interest deduction. Do you think that that's something that could get thrown out in the future?
I don't think so. It would kill the housing market. Even the SALT cap, well, it didn't affect the mortgage interest, but there is a cap, but it's a very high cap.
Right.
But
it went from $1 million to $750, right?
Maybe that's a tip of the iceberg. But you don't want to destroy the housing market. In fact, somebody just asked me on the way over here today, is the deduction, is that a good time? They figure the deduction is figured in when people go to buy a house and they figure, well, you'll get this deduction, so it's not really costing me as much. They figure that into the cash flow.
All right, we'll get back to our interview with Ed Slott in just a minute. If you'd like to ask us a question, just send us an email. Ask Jill at JillOnMoney.com. Hey, during the break, hop onto the website, JillOnMoney.com, and there you can sign up for our free weekly newsletter. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back with Jill on Money, and we are talking about it's tax season, the height of tax season. And for those of you who find yourself struggling to get started, this is your official kick in the butt. Get started. Let's get back to our interview with IRA expert and CPA Ed Slott. We're talking about Roth IRAs in this segment. Really important topic for everyone. Let's talk about, so your favorite always is the Roth. We love that.
I love having tax-free money for your retirement. And to all the young people, if you have young people listening.
We got plenty of them.
All right. This is a no-brainer. It's a slam dunk. There are things, and I'm sure you give this advice all the time. You don't really know. It depends on facts and circumstances. Right. Wishy-washy, probably, maybe, could be.
Just do it.
With the Roth for young people, it's a slam dunk. Every young person should be doing a Roth 401k at work. We didn't have that option to start from day one, building a tax-free savings account, a Roth IRA. So here's my advice for all our kids, the millennials. Mm-hmm. Stop taking pictures of your food and open a Roth IRA.
Wait a minute. We just have the name of the show. Stop taking pictures of your food. Open a Roth.
My kids are in their 20s. They look, a hamburger. Haven't seen one of those before.
Yeah, it's amazing. I was like, how about enjoy the experience and don't document it? Healthcare costs going up. Lots going on there,
that's
right?
That's a tough one.
And you talk about the health savings accounts. And this is a bit of a thorny issue because not everybody has access to a health savings account.
It's an outlier, but it's just something to know that you have an account that actually is triple tax-free. They used to say that with bonds, federal, state, and city, triple tax-free, because you get a deduction going in, it grows tax-free, and if you use it for health costs, it's tax-free coming out.
And unlike most flexible savings, there's no worry about what
use
it or lose it or carry forward. This is yours for life. And
once you're on Medicare at 65, you can't use it.
You can't use it, but you could use the money that was in it.
Yeah. You just can't add.
Right, so you can't add to it. By the way, all of these, the earned income tax credit, which is still a big credit.
Right.
There's also
the new child tax credit is a big deal, but it's a little sneaky. It's under 17. Now, that's great. So that could replace the lost benefit of the exemption. But when you have older kids, that's when you need that's when you need that credit. They're maybe going to college, you have other expenses, they're still in the house.
Right.
And then the credit drops to like $500.
Because that's the other. But what do you have to do to claim your parent as a dependent? Because I noticed it says other family, not just kids over 17. They say other family.
Oh, yeah. Well, that's been around. I mean, if you have a family member, it doesn't have to be a parent. It could be anybody.
Right.
Somebody lives in your house, you're providing the support, more than half the support. Yeah, you can claim that person. That hasn't changed.
All right. Give us sort of the 3 big mistakes that people need to avoid this tax season.
All right. Well, on the IRA contributions, that's the one thing you can still fix from last year. So on the IRA, I always say make your IRA contributions early in the year. So now you want to do it for 2019. But if you didn't do 18, you can still do 18 up to April 15th. When you go back, the mistake is people go do their taxes now, right? Mm-hmm. And then the accountant, and I am one, I'm a CPA, and I have to say this about my profession, we're basically only history teachers. We tell people what already happened. So they go to their accountants, and the accountant is saying the same thing oh, you should have done this. Oh, you didn't do. Oh, you're too bad. You should have done this. Woulda, coulda, shoulda. So maybe change the equation and look ahead. Now, it's hard to compare 2 systems. We have 2 different systems, 17 and 18. But this year, take the results of 18 and do something about it now going forward. So when the accountant or your tax preparer, or even if you're looking at a screen on TurboTax or something, even them, they're probably saying, oh, you should have done that. Mm-hmm. Did you do that? And you'll sit there and say, oh, no, I didn't do it. So go think ahead, be proactive instead of reactive.
What about the actual completion of the returns? I think that all of those crazy expenses that people tried to deduct are no longer allowable.
Yeah, the miscellaneous itemized deductions.
So that's all done anyway.
Yeah.
What about like people who do work out of their homes? Should they worry about being an audit flag if you claim that your house is your office and that kind of stuff?
Well, there's a form for it, and you have to be legitimate. You can't say you're using your whole house exclusively for work. At some place you have to sleep and eat and do other things besides work.
And also the IRS budget's been hacked away so much.
But that's not a reason.
I'm totally kidding.
That reminds me, I get this question all the time from tax professionals at seminars, and they'll ask me, they'll talk about a certain deduction, and then it'll always come up that says, but how are they going to know? And I always answer the same way. I don't know. Ask the guy in the cell next to you.
Yeah, exactly. Still, you would rank Roth being your favorite thing ever.
I take advantage of low rates.
What about QCD? You still love that.
I love that, but the only problem is it applies only to a limited population. But everybody giving to charity, it's great you brought that up. Qualified charitable distributions. It only applies to people over 70 and a half years old that have IRAs and have RMDs from these IRAs. It's a way to move the money directly from the IRA to charity and offset the income. It lowers your income. And I'm not telling people get confused. They say, oh, if you give more to charity, you get a bigger break. No, I'm saying give the same, just give it a different way. Use this qualified, some people call it the charitable IRA rollover, but it's the QCD, as you said. And you will pay less tax giving the same money. But they haven't been doing. This is one of those things that are going to happen to people right now when they're doing their taxes and they give the accountant all the receipts for charity, and the accountant says, you don't even qualify for this because you're taking a standard deduction. With the QCD, you get the standard deduction and, in effect, the charitable deduction. You don't get both. Actually, it's better than an extra deduction because it's an exclusion from income. It lowers your adjusted gross income, which is a key figure on the return that triggers all other benefits. So anybody that qualifies, it's only for IRA owners who are 70 and a half years old or older, but that's the way to give charity.
Yeah, I did it for my mom. She
it's
loved
a great
it.
move.
She said it was great. It's a little bit of a paperwork pain in the butt, but it was fine.
Well, charities are behind the eight ball, which I don't understand because it's hard to get them to change their ways. Stop writing checks and go to the charity and say, you want to make some real money? Every charity wants money. Try helping people do these qualified direct transfers. Then you'll see money rolling in on automatic. So if you're a charity listening, this is the way to bring in big money.
All right. Thanks so much to Ed Slott for joining us today. If you haven't gotten the excitement necessary to start your taxes, I don't know what's going to do it. When we return, we're going to answer more of your questions. Just give us a holler. Ask Jill at JillOnMoney.com. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. Our email address, askjill at JillOnMoney.com. Ask Jill at JillOnMoney.com. Hey, college acceptance season around the corner. So, not the best time for you to talk to your kids about money, but maybe for everyone who's thinking about college in general, you may want to start thinking about this before the time comes up, like freshman year, something like that. Not when they're seniors. All right. There's a question about the corporate tax cut and some of the prognosticators, people like me, who basically have been talking about how the effect of the corporate tax cut is starting to wane. That is mostly because not just the repatriation of funds, but that companies use the money to buy back their stock, which juiced the returns of the stock market, sort of almost artificially. But also that the spending, the actual capital expenditure is kind of not as big as you would have thought. And that's essentially why, Marcus, that, it's not going to be quite as good. Also, the comparisons to last year are not going to be as good because now they're kind of used to that. So you don't see the big bump year over year. So here's one, a realistic financial plan for a college student. So this student is overwhelmed. And I attend university. I work at a minimum wage job on campus. It allows me to study for my vigorous academic program. I have no help from my parents. I receive need-based grants and federal student loans to cover academic expenses. I find myself trying to save a little extra cash for a car, but this seems impossible because of my lack of cash flow. I've spent some semesters tightening my belt so much that I'm miserable eating ramen. I am miserable eating ramen with a little money. Ay, ay, ay. Is there any way to remedy this and start saving as a student? Or is it more plausible to wait until I am in my career? I'll pick option B. Why are you trying to save right now? It's not reasonable. You shouldn't be eating ramen noodles. You should be studying hard so you can get a great job. That's what you got to do. And if you can try to do that, I think that's going to really work to your benefit. Max writes, my partner will be turning 65 next autumn. And this is more of a tax question than anything. She's enrolled in Obamacare. She knows to initiate her sign up for Medicare 3 months before her birthday. She also knows that Obamacare will need to be canceled as soon as she turns 65. Not doing so will incur a non-subsidized premium for Obama coverage for the period she is still enrolled in it. This is where my question comes in. Gosh, I hope I know the answer to this because all of a sudden it seems quite technical. Since she is receiving a subsidy for the Affordable Care Act coverage, she has a modified adjusted gross income dollar amount she has to stay within to keep that subsidy. For tax year 2019, she will have received Obamacare for 9 months. She will then face, in preparing taxes for 2019, a situation where her modified adjusted gross income will have to be approximately 75% of what it was in 2018 to retain the subsidy. I can't find a plain vanilla answer for the situation. Partner turns 65. She transitions from ACA coverage to Medicare. When preparing taxes, will the ACA rules affect her income earnings up until the date she dropped Obamacare and prorate for the modified adjusted gross income for the total time in 2019 she was enrolled, or does Affordable Care Act rules look at the 2019 final modified adjusted gross income as long as she stayed under it? Mark, you want to weigh in on this? I'm throwing my hands up. I have no idea. As one Social Security expert said, just call. No, that's not the answer. I think that this is my inclination. I don't think they prorate. I think I'll tell you what. I don't think they prorate. But that said, what I would do, because I think that you may want to do this through the Medicare system. So I might actually call the Medicare system, and they have better phone people than almost any other agency, just because a lot of people who are over the age of 65 in the past have not been as tech savvy. So they tend to man and woman their phone lines a little bit more robustly. So what I would say is this. I don't know the answer. If anyone else knows the answer, anyone else who has transitioned from ACA to Medicare, I might search it online, but then try to call. I think I would call Medicare to find out what the deal is. I feel like they're going to be more helpful than trying to go through whatever Affordable Care Act resource there could be. Just my 2 cents. I think that's about it. All right, listen, we're coming up on a break. And if you want to make the break really useful, go to the website, jillonmoney.com. And there you can read stuff that I've written. You can listen to past shows. You can watch cool TV segments and other stuff, things that I'm doing, hawking the book. You can sign up for our free weekly newsletter. And speaking about that book, I listen to every show. And what you might find humorous is I do laugh at the amount of time that I have to actually go back and say to myself, I can't believe I've become one of those people who's just selling a book. But here I am. Probably will just do it for this year. But get ready. It's going to be the whole year. All right. It's Jill on Money. When we come back, more of your fabulous questions. Send us an email. Ask Jill at jillonmoney.com. We'll be right back. You're back with Jill on Money. If you have a financial question, we would love to hear from you. Hey, Mark, where are we broadcasting live from this hour? We are broadcasting live from the Policy Genius Studios. Policy Genius is the easy way to compare and buy insurance. Isn't that awesome? Love that. And love the CEO, Jennifer Fitzgerald. We've had her on the show. Fantastic. So go check it out. You need some insurance? That's one of the dumb things that I outline in my book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. One of my dumb things is you buy the wrong kinds of insurance or none at all. That's bad when you buy none at all and you need it. Oof. So check out Policy Genius. Okay. Speaking about the book, we got a question from Janice about reverse mortgages. And, it's funny. When I wanted to start the book, one of the things that I thought was so confusing is that people would just buy stuff that they saw either advertised, late night TV, or proposed to them by someone they didn't know. And so one of the dumb things that we start the book off with is you buy financial products that you don't understand. One of the products that I highlight in that book is essentially that you buy a reverse mortgage without really understanding it. And why is this so important? Because a reverse mortgage can be a great product. In other words, here's how it works. You're over 62. You got a bunch of equity in your house. You don't have a lot of savings. And this is a way to kind of get the money out of the house without you having to sell the house. This is something that becomes incredibly important over time, which is that when people buy stuff that they don't quite understand and they think they've got something great, it's tough. So I highlight reverse mortgage as one of these products because it's really hard to understand whether this is the right thing for you. So what is the answer to that? Buy the book, obviously. But instead of buying a financial product like a reverse mortgage, before you kind of get what's going on, talk to somebody, a fee-only planner who can give you advice. That's what you're going to do, because that will allow you to ask the right questions of yourself and the product. Okay, you're listening to Jill on Money, and thanks so much for listening. You've been fantastic. Give us a shout. Ask Jill at jillonmoney.com. Throughout the week, just hop on the website, jillonmoney.com. All our stuff is there. We'll see you next week.